Welcome to the channel. Today we will talk about ETFs, or exchange-traded funds, have revolutionized the way people invest. They offer diversification, lower fees than traditional mutual funds, and accessibility to a broad range of assets. In this guide, we'll explore what ETFs are, how they work, and why they are a crucial tool for both beginner and experienced investors. 1. Understanding ETFs. An exchange-traded fund is a type of investment fund that holds a diversified portfolio of assets, such as stocks, bonds, or commodities. Unlike mutual funds, which are only traded at the end of the trading day, ETFs trade on stock exchanges throughout the day like individual stocks. Key characteristics. Diversification. ETFs provide exposure to multiple assets, reducing the risk of holding a single stock. Liquidity. They can be bought and sold easily throughout the trading day. Lower fees. Most ETFs have significantly lower expense ratios compared to actively managed mutual funds. Transparency. ETFs regularly disclose their holdings, ensuring investors know what they own. Tax efficiency. Due to their unique structure, ETFs often generate fewer capital gains taxes compared to mutual funds. The Coinbase wallet is best if you need crypto, and check the link in the description. The Coinbase wallet is best if you need crypto, and check the link in the description. 2. Why are ETFs important? ETFs typically have lower management fees than traditional mutual funds. The average expense ratio for ETFs is around 0.1%–0.5%, while mutual funds often charge 1% or more. This cost advantage means investors can keep more of their returns. Accessibility for beginners. Investing in individual stocks requires research and expertise. ETFs simplify this by offering exposure to a broad market index like the S&P 500, reducing the need for stock-picking skills. Risk management. Through diversification. By holding a basket of assets, ETFs reduce the impact of poor performance from a single company or sector. This makes them an ideal choice for long-term investors. The cloud mining app for Android is perfect. Check the link in the description. The cloud mining app for Android is perfect. Check the link in the description. 3. Types of ETFs. ETFs come in various forms, each serving different investment strategies. Stock ETFs track major indices like the S&P 500, NASDAQ, or global markets. Bond ETFs provide exposure to government, corporate, or municipal bonds, offering stability. Commodity ETFs invest in physical commodities like gold, silver, or oil. 4. How to choose the right ETF. Selecting the right ETF depends on an investor's goals, risk tolerance, and time horizon. Define your investment goals. Long-term growth. Broad market ETFs like the S&P 500 or MSCI World. Income generation, dividend ETFs or bond ETFs. Sector exposure, technology or healthcare ETFs. Consider expense ratios. Lower expense ratios mean lower costs and better long-term returns. Analyze performance and holding. Look at past performance, sector allocation, and underlying assets. 5. Common mistakes to avoid. Ignoring fees. Even small expense ratio differences can add up over time. Chasing performance. Investing based on past performance can lead to poor future returns. Not understanding holdings. Some ETFs might contain unexpected assets. Over-diversification. Holding too many similar ETFs can dilute returns. Ignoring market conditions. Some sectors perform better in different economic cycles. The Coinbase wallet is best if you need crypto, and check the link in the description. Thanks for watching.